Welcome to the Variable Life Insurance Investment Linked Products e-learning course brought to you by AXA Philippines Distribution Learning and Development. Click on the Start button to begin. What is the Variable Life Insurance or Investment Linked Products training? It's a program covering variable life insurance concepts designed to equip you with the knowledge to become a successful financial advisor. Completion of this e-learning course is important to get a training certification, and you need to pass the licensing exam given by the Insurance Commission. These navigation buttons appear throughout this course. Use them to proceed, go to previous, or go back to start. Course menu. Click on Module 1 to get started. Module 1, the basics of investments. In this section, you will learn what an investment is, how investments earn money, types of investments, and these are deposits or cash, securities, property or real estate. Click on the Start button when you're ready. An investment is an asset purchased with the expectation that it'll generate income or appreciate, meaning increase in value over time. Common investments come in the form of stocks, bonds, real estate, and mutual funds. Many investments trade daily on the public market. Current events and company performance can cause a company's stock to rise or fall. Significant events can affect the stock market itself. Imagine if someone follows sound investment practices. The longer they invest, the greater the chance they'll grow their wealth. On the other hand, the shorter the period of investment, the risk is higher of that investment losing money. Remember that with any investment, there is always a risk that an asset's value will decline rather than increase. But despite the risk, investments are one of the best ways of growing your money when you invest wisely. Let's take this example. Two people have the same amount of money, in this case, 100,000. One of them places his money in a checking account that earns no interest. The other person invests in a variety of mutual funds. Every day, the investments made in mutual funds change in value. Over 10 years, the average investment growth was at the range of 7.2% each year. This translated to his investment growing to around 200,000. In comparison, the amount of money held in the checking account remained the same. Now let's answer the question. Is an investment something that refers to assets acquired to realize income and/or earn profit? Is it expected to increase one's equity or reduce future financial worries? Is it something that protects one's financial resources from inflation? Click on an answer below. Is it A, B, or C? That's correct. All three answers describe what an investment is. You will now learn how investments earn money, and this happens through capital appreciation, dividends, interest, and capital gains. Move on to learn more. Let's start with capital appreciation. It's an increase in an investment's market price. Let's say someone buys one share from this company for 100 pesos. That single share of this company is trading at 150 pesos a year later. Capital appreciation is 50 pesos. The investment has increased by 50% of its original purchase price or its cost basis. All the investor had to do was hold it. Capital appreciation is regarded as one of the two main sources of investment returns, with the other being dividend or interest income. Now let's talk about dividends. As defined, it is income received as a business owner. Let's look at this example. A man wants to open a new business. To do this, he gathers money from investors and issues shares. After some time in operation, the business is successful and sales are high. The owner now has the ability to either invest in growing the business or pay off his investors. He decides to use the funds he has to give back to his investors in the form of dividends. And these dividends are a distribution of a portion of a company's earnings, decided by the board of directors to its shareholders. Now that we have an understanding of dividends, you might be asking, how do dividends work in life insurance? Here's how. Dividends are generated from the profits of an insurance company that sold the policy and are typically paid out on an annual basis over the life of the policy. Most policies also include a final or terminal payment that is paid out to the holder when the contract matures. Some participating policies may include a guaranteed dividend amount, which is determined at the onset of the policy. Now on to interest. It's the price charged to borrow money and is typically expressed as a percentage of the principal or the amount loaned. Someone who borrows money from the bank to open a business or buy a bigger house will pay interest on that loan. The bank makes money from the interest it charges. Contemporaneously, the borrower pays the interest for the privilege of using the loan. Interest rates are either simple or compounding. With simple interest, the rate paid is a fixed percentage of the loan. In compounding interest, both the principal and the accumulating interest are subject to interest fees. Suppose our friend here borrows $200,000 to buy a car. If he has 5 years to pay the loan, and the bank charges a simple interest of 6%, he will pay $60,000 in interest plus the principal. To calculate the interest paid, multiply the principal by the interest rate and then by the time of the loan. He also puts $1,000 into an investment that offers 5% annual compounding interest. After 3 years, that investment will increase to $1,157.63, thanks to the power of compounding interest. To calculate compounding interest, multiply the principal amount by 1 plus the annual interest rate raised to the number of compound period, minus 1. Capital gains. This is profit from sale of assets, or an amount by which an asset's selling price exceeds its initial purchase price. In other words, a capital gain refers to the increase in value of a capital asset or an investment security upon sale. Take this example. If you buy company stock, property, or a vehicle and then sell it for more than you paid, you have a capital gain. Remember that capital gain is only realized upon sale, even if your investment rises in value during the time you own it. Types of investments: deposits or cash, securities, property or real estate. Deposits or cash. This refers to all liquid instruments that carry little or no risk that the principal amounts invested can be lost. A liquid asset is something you own that can easily be converted to cash. The easier it is to convert to cash, the more it's considered to be liquid. They represent investments that are highest in safety and provide the lowest returns. These types of investments cover bank accounts, namely savings, involves a minimum deposit and comes with interest. Checking provides easy access to funds through writing of checks. This may or may not have interest. Time deposit, minimum deposit with a holding period. Offshore account, a foreign currency account outside the country. Investment managed account. This involves high investment requirements and are handled by fund managers. Foreign currency deposit account. Local banks offering foreign currency deposits. Securities. Written evidence of ownership, interest, or participation in an enterprise, or written evidence of indebtedness of a person or enterprise. In this section, we will look at classifications of market securities and the different types of securities. There are two aspects to the classifications of market securities: a classification based on maturity and a classification based on who the seller is. Classifications of market securities based on maturity come in two forms: money market and capital market. Move on to learn more. Classifications of securities based on maturity. Money market. Money markets are safe, liquid investments that are well suited to the small investor. They typically invest in steady funds like treasury bills and commercial paper. Money market funds are short-term. Funds are invested within a limited period of time. Opening a money market account is as simple as opening a savings account, but with a couple of differences. The account usually requires a minimum balance to open and be maintained at, and you must leave your money for a specific period. While money market funds don't guarantee a huge return, they have higher interest rates than savings accounts and are more convenient for short-term investors. Classifications of securities based on maturity. Capital markets. Defined as medium to long-term, 3 to 5 years and longer. Capital markets channel savings and investments between suppliers of capital like retail investors and institutional investors to users of capital, such as businesses, governments, and individuals. They do this by selling financial products like equity and debt security. Equity securities, also called stock, are ownership shares in an organization. Debt securities, such as bonds, are interest-bearing IOUs. The term IOU is an abbreviation in phonetic terms of I owe you. This is an informal document that acknowledges a debt owed, and this debt does not necessarily involve a monetary value, as it can also involve physical products. Due to the informality of IOUs, those issuing them have full control over writing and issuing it. Classifications of securities based on who the seller is. Primary market and secondary market. Corporations and governments finance their activities by issuing stocks or bonds which are purchased by the public directly from the issuing corporation or government entity. This is what's called a primary market. It provides investors the first chance to purchase a new security. These sales are called initial public offerings or IPOs. Because initial demand is not easy to anticipate, the initial sale price is often set very low, thus making the primary market quite volatile. Once the securities are sold to the public through the primary market, any subsequent sales of the stocks or bonds takes place in secondary markets, like the local Philippine Stock Exchange and NASDAQ in the United States. Types of securities: credit, fixed income, stocks, equities, unit investment trust fund, mutual fund, derivatives. Credit, fixed income security. The periodic return on investment is the same throughout the life of the security. The principal is returned at the time of maturity. The rate of return for the security is fixed at the time of purchase. The investor knows exactly what the earnings will be. Because of this, fixed income securities usually have a lower rate of return. This is suitable for risk-averse investors. Take this example. An investor could own a 30-year treasury bond with a face amount of $1,000 and an interest rate of 4%. The investor can anticipate receiving 40 in annual interest payments for 30 years, at which time the investor will receive the final interest payment plus the return of his $1,000 principal. Fixed income securities are investment vehicles with a fixed periodic return. They are regarded as IOUs or promissory notes from companies and the government. They may be short or long-term and are considered a safe type of investment. Here are the three types of fixed income securities: commercial paper, bonds, and government securities. Commercial paper, a short-term debt security that is issued by financial companies and large corporations. The corporation promises the buyer a return or profit from making the loan. The return is stated as an interest rate or a percentage of the loan, such as 5%. Companies sell commercial paper when they need a short-term loan to pay for such things as accounts payable and inventory. The security is generally sold at a discount and redeemed at full value. The gain is the interest payment. Most commercial paper mature in 1 to 6 months, and some mature up to 9 months. Commercial paper is part of the money market. By avoiding SEC registration, it is less costly. By issuing commercial papers for short-term funds, companies avoid the time and cost for applying for business loans as well as SEC registration. Commercial paper is unsecured, meaning buyers have no claim on a company's assets if the company fails to pay up at maturity. In this respect, only the companies, corporations, and firms with good credit can successfully sell commercial paper. Commercial papers are considered promissory notes issued by big firms or blue-chip companies, companies of unquestionable credit standing and reputation. Describing a company as blue chip comes from the game of poker, where blue chips are the most valuable. A blue chip corporation is large and stable, and is a leading company in its business segment, and is recognized nationally and even internationally for their well-known services or products. Blue chip companies usually have a market value in the billions. Their stock can perform similarly to the stock market itself. Blue chips are usually considered safer than lesser-known companies. Commercial papers can be bought directly from these blue chip companies or investment houses. Bond. A bond is a debt instrument issued by the government, corporations, and other entities in order to finance their activities. Quite simply, a bond is a loan an investor makes to whoever is issuing the bond. The price of a bond when it's first issued is basically the amount of money being loaned and is referred to as the bond's face value. In exchange for this loan, the investor receives interest, known as the bond's coupon. Bonds are issued for a specified period of time. For example, 1, 5, or 20 years. When the end of this period has been reached, the bond matures and the bond's issuer returns the money to the investor. Take this example. A business owner decides to build more branches to expand his business. Instead of taking a bank loan, the owner issues bonds for sale to the public. Someone buys a bond with a face value of 1,000. It has a coupon or interest rate of 8% and a maturity date of 10 years. This means the investor will receive 80 or 8% of 1,000 every year for the next 10 years. When the bond matures, at the end of 10 years, the bond issuer will return the 1,000 investment. The investor could also sell his bond before it matures. Corporations often issue bonds to fund capital projects, and the government issues bonds to pay for public projects. There are many types of bonds, but it's important you remember that the higher the interest rate on a bond, the more risk it is likely to carry. A bond is a certificate of indebtedness with fixed interest rate and maturity date. It can be issued by a government or private companies. Borrowers get funds while investors get interest earnings. Classifications of bonds: as to the issuing party, as to security, as to maturity of principal. Classifications of bonds as to the issuing party. Government bonds, issued by government as a way to raise funds by borrowing money from the public. Corporate or commercial bonds, issued for project funding or capital accumulation. Let's look at both of them closely. A government bond is a debt security that the government issues. When the government issues a bond, it's positioning itself to get a loan. The lender receives interest payments plus its principal back when the bond matures. If you buy a bond from the government at 1,000 with a 5% interest rate, you'll receive 50 a year until it matures and your original 1,000 back. The government uses the money it borrows through bonds to fund activities and projects like building or repairing infrastructure. The government is the largest issuer of debt securities, and these are regarded as the safest because bonds are backed by the full faith of the government. The chance of these bonds failing are small. Remember that when risk is small, so is the return, and borrowing a government bond will typically provide a small interest rate. Corporate bonds. A corporate bond is a debt security issued by a corporation and sold to investors. The backing for the bond is usually the payment ability of the company, which is typically money to be earned from future operations. In some cases, the company's physical assets may be used as collateral for bonds. Corporate bonds are considered to have higher risk than government bonds. As a result, interest rates are almost always higher on corporate bonds, even for companies with top-notch credit quality. For example, a 5-year Treasury bond can yield just over 1.08% on average, while the average yield on 5-year corporate bonds can range from 1.57 to 1.79%. Classifications of bonds as to security. Mortgage bonds. This is a type of bond representing an investment in a pool of real estate loans. To better explain, take this example. When a bank issues a mortgage, let's say you want to buy a house that costs $500,000. Typically, you would go to a bank and apply for a mortgage loan of the same amount. In return for loaning the money, the bank will make you pay interest on the loan at, for example, 8%. The bank sells the stream of interest and principal payments from the loan to investors. To do this, the bank bundles your loan together with others, then the bundle of mortgages is sold through an investment bank in the form of a bond. Mortgage bonds allow a bank to free up capital and provide investors a way to buy into mortgages. Equipment trust bonds. A debt instrument that allows a company to take possession of an asset and pay for it over time. The debt is secured by the equipment or physical assets. When the debt is paid off, the equipment becomes the property of the insurer, as the title is transferred to the company. These certificates were originally used to finance railway boxcars, and the boxcars were used as collateral. Nowadays, equipment trusts are used to finance containers used for shipping and offshore businesses. Collateral trust bonds. A collateral trust bond is a bond that is secured by a financial asset, such as a stock or other bonds, and deposited and held by a trustee, or a person or firm that holds the assets for the holders of the bond. If the issuing company were to default, in other words, fail to pay the debt obligation, the debt holders would receive the securities held in trust, like collateral for a loan. Debenture bonds. A debenture bond is a form of government or corporate borrowing that is different in some ways when compared to a traditional bond. The key difference is that debentures are not secured by a specific asset, but rather, lenders rely on the overall credit reputation of the issuer. Bondholders demand higher interest rates on debentures due to their unsecured nature that carries extra risk. An example of a government debenture would be any government-issued treasury bond or treasury bill. T-bonds and T-bills are generally considered risk-free because governments can print off more money or raise taxes to pay these debts. Debentures are the most common form of long-term loans that can be taken out by a corporation. The loans are normally repayable on a fixed date and pay a fixed rate of interest. Classifications of bonds as to maturity of principal. Straight bonds. A straight bond is the most basic of debt investments. It is a bond that pays interest at regular intervals and at maturity pays back the principal that was originally invested. Straight bonds are debt instruments because they are essentially loaning money to an entity. The entity, whether government, municipality, or organization, promises to pay the interest on the debt and at maturity pay back the original loan. Serial bonds. A serial bond is one that is structured so that a portion of the outstanding bonds mature at regular intervals until all of the bonds have matured. These bonds are used to finance projects that provide a consistent income stream for bond repayment because the bonds mature gradually over a period of years. The entire bond issue is sold to the public on the same date, and the maturity dates are stated in the offering documents. Convertible bonds. A convertible bond is a bond that an investor can exchange for a specific amount of company stock at a later date. It combines a bond and a call option. The bondholder benefits when there is an increase in the value of the stock. For example, someone buys a bond worth $500 from a small company with a coupon of 5%. If this bond has a 10-to-1 conversion ratio, it can be converted to 10 shares of stock with a conversion price of 50. Provided the potentially greater upside value, convertible bonds are generally more attractive to investors than traditional bonds. Callable bond. Callable bonds are bonds that can be paid back by the issuer before its maturity date. These are bonds that can have the principal paid back early by the issuer. If a bond is called, it'll naturally generate lower income from losing the interest that was supposed to be paid if it was allowed to mature. Government securities. Government securities are debt instruments issued by a government to raise capital. It is a loan an investor makes to a government. The government, in return, pays interest on defined dates, and the principal is returned when the maturity date is reached. Government securities come in two forms, and these are treasury bills. They mature in less than a year and are offered in three terms, 91, 182, and 364 days. Then there are treasury bonds, which mature beyond a year. Let's look at them closely. The treasury bill is an instrument that has the shortest maturity. A characteristic of a T-bill is that the government does not pay interest regularly to the holder because the price is set below the face value, which results in profit when it reaches maturity. For example, if you buy a T-bill with a 52-week maturity and a face value of $10,000 and is sold at $9,700, given the $300 interest income, the yield is 3.1%. T-bills offer the benefit of a lack of risk because the government is likely to make good on the security. Treasury bonds. Another instrument the government uses is the treasury bond. These are marketable medium to long-term securities that regularly pay interest. These payments are known as coupon payments. A T-bond is regarded as relatively less risky as an investment because they are direct obligations of the government. Stocks, equities. Stock investment refers to acquisition of shares of stocks of other corporations to realize profit upon their sale and for periodic income in the form of dividends. A share of stock is in effect a unit of ownership in a corporation, so that stock investment is in effect an investment in a portion of the equity in a corporation. Private company stocks are not listed on the Philippine Stock Exchange and are not available to ordinary investors. Publicly listed company shares can be quoted on the PSE if they meet the exchange's requirements. The workings of the Philippine Stock Exchange are regulated by the Securities and Exchange Commission to protect the investing public. The value of a share fluctuates according to the market's view of the worth of the company. If a company is doing well, its share price will tend to rise, and if it's doing badly, it will tend to fall. A share can be a volatile investment, meaning it may not be constant. A shareholder must therefore realize that he could lose all his money in the invested share. Types of stock. Common and preferred stock. Many know about common stock. It represents the basic ownership in a corporation and carries with it the right to vote on corporate matters. Preferred stocks. It's another form of company ownership. The main distinction between the two is that preferred stock offers investors an added layer of protection. If a company is performing well, preferred stock owners have a claim on assets before common shareholders. Preferred stock offers great income security when a company is stable. Preferred stock pays set dividends in regular intervals. Ownership of preferred stock does not carry with it any voting shares. Holders of these shares hold no control over a company. Unit Investment Trust Fund. A fund that's managed by an investment company and offers a fixed portfolio of stocks and bonds that are designed to provide capital appreciation or dividend income for a specific period of time. Take this example. When you purchase a unit investment trust for $1,000, it'll be composed of underlying securities, and it issues redeemable units and interest to the investor at the end of a quarter. The UIT can be terminated on a fixed date, and at that time, the investor receives the fund's going price that depends on the current value of its stocks and bonds. This type of fund has no investment advisors or a board of directors. This means more money for the investor. UITFs can be sold in the secondary market. This fund is a form of collective investment where money is pooled, giving a portfolio of funds. Advantageous for a private investor, offering a portfolio of funds at minimal cost. There are three types of trust funds. The fixed income fund, which offers a regular income at prevailing rates, such as T-bills, CPs, and bonds. Equity fund, mainly stock issues. A balanced fund, both fixed income instruments and equity issues. Fixed income fund. Primarily, investments are made with fixed income instruments and other forms of financial instruments offering regular income. Investments follow prevailing rates. Examples of this are treasury bills, commercial paper, and bonds. Equity funds. Investments are made principally in stock issues. An investor may benefit from the experience of a manager as a seasoned stock selector to buy a portfolio of stocks. Instead of purchasing singular stocks at higher costs, an investor is given a diverse set that offers the objectives he wants, and the investor needs to be aware that the risk is higher in an equity fund, and this will dictate the returns. balanced fund, equity and income components, and how each perform are the focus of a fund that combines a bond component, a stock component, and sometimes a money market component in one portfolio. It is characteristic of a balanced fund to retain a fixed mix of bonds and stocks. Mutual fund, a stock corporation that pools money from numerous investors by issuing shares and investing the pooled funds in accordance with the objectives and policies. Pools the capital of several individual investors. The capital is invested in a set portfolio. Let's look at this example. Here's an investor whose investment objectives are to put his money in a balanced portfolio. He breaks it down this way. He wants cash, bonds, and stocks, where the allocations are 20% for cash, 30% for bonds, and 50% for stocks. But as the investor only has 50 to invest, this removes him from making the investment on his own. This is where a mutual fund becomes the option. The investor joins a pool of other investors who have the same objectives. By purchasing units in the fund, he is able to reach an effective exposure that meets his objectives. This allows individual investors to allocate their money in more ways than one. Types of investment companies: open-end companies and closed-end companies. An open-end company continuously issues its redeemable shares and stands ready to redeem them back at net asset value per unit should investors decide to pull their investments out. This type of company is not traded in the Philippine Stock Exchange. Open-end is another term for a mutual fund. The most common open-end management companies are mutual fund companies that sell and redeem shares at the net asset value per unit. An investor in an open-end fund essentially pools his or her money with other investors according to their objectives. Closed-end companies: an investment company that issues a limited number of non-redeemable shares so that they are listed in the stock exchange to provide liquidity to their shareholders. They are listed in the Philippine Stock Exchange, dealing mostly in bonds and preferred stocks. It sells to investors on an exchange by way of an initial public offering. Investors must be willing to buy the shares at a price determined by the market and, if they need to, sell their own shares at the market price of the security, even if that price is significantly below the net asset value of the portfolio. It is common for the price of closed-end funds to be above or below the actual net asset value per unit. The most common type of closed-end management company is a closed-end mutual fund. Here are the differences between a mutual fund and a trust fund, according to issuing entity, instrument issued, regulatory body, and minimum investment. Beyond these differences, a mutual fund account can be opened by talking to a licensed mutual fund agent to identify risk tolerance, capacity to invest, and investment goal. A UITF account can be opened by talking to a trust representative of a bank. Banks usually have special representatives for trust investments and related products. Advantages of investing in a mutual fund: they are usually more and well regulated since companies focus on their funds and their performance. Reports are more transparent because shareholders need to know fund performance, reporting, portfolios, dividends, and so on. It may give investors dividends and other shareholders' rights. Disadvantages of investing in a mutual fund: they charge entry fees and management fees. Mutual fund companies are not so easy to find like banks where branches are almost everywhere. Advantages of investing in a UITF: easy access because you can open an account in any branch that's near you. They offer a wide variety of funds to be chosen from. No entry fees and costly management fees. Disadvantage of investing in a UITF: it won't make the investor part of the company and won't give shareholders rights. The similarities of mutual funds and UITFs: both funds are pooled and open-ended, meaning they are pooled by different kinds of funds, people, and companies to be invested and diversified to other investments like stocks, bonds, securities, money market, and other mutual funds and trust funds. You can buy and redeem them at any time. Both funds are managed by fund managers who are already experts on investment fund growth, strategies, and meeting target performance. Both fund investments are risky in nature. However, they can provide high returns and can yield money and capital growth. Mutual funds and UITFs usually offer the following types of funds and investments: money market funds, bond funds, equity funds, balanced funds, and both funds are not insured by the PDIC because they are not deposit accounts. Derivatives, financial instruments with values linked to the price of underlying instruments in the cash market. A product that derives its value from assets, such as equities or fixed income products. The value of money is dependent on where it's tied up. The derivative itself is a contract between two or more parties based upon the asset or assets. The most common underlying assets include stocks, bonds, commodities, currencies, interest rates, and market indexes. Derivatives can either be traded over the counter or on an exchange. Over-the-counter derivatives constitute the greater proportion of derivatives in existence and are unregulated, making their risk level generally higher. Forms of derivatives. Futures contracts, better known as futures, one of the most common types of derivatives. These are obligations to buy or sell specific commodity on a specific day for a present price. Advanced buying and forecasting are necessary. One would generally use a futures contract to guard against risk during a particular period of time. For example, let's look at the relationship between two businesses, a t-shirt manufacturer and a textile mill. The textile mill is the t-shirt manufacturer's supplier. Understanding that the cost of raw textile can increase or decrease over a period of time and over a certain set of market conditions, this volatility has a direct effect on the t-shirt manufacturer's expenses. A futures contract can help both of them by negotiating an agreement with an investor to protect their businesses from rising prices and other circumstances affecting their business. Options contract. This provides the owner the right to buy or sell a specific item for a given price during a specified period of time in the future. An option can be short or long, as well as a call or a put. A call option provides the right to buy a security in the future. A put option gives the right to sell the security in the future. Properties. Real estate refers to land and all permanent improvements thereon, including buildings. There are three types of real estate investments. These are domestic or residential, commercial or industrial, and agricultural. The price and value of the three types of real property generally depend on certain factors as follows. For domestic and residential, location, size, and type of structure and rental potential. For commercial or industrial, location, size, type, and use of structures and rental potential. For agricultural, quality of soil, suitability to crops, location, function of structures, and proximity to water sources and feeder roads. The advantages of investing in real estate. It's a hedge against inflation. It's a finite investment. It's one of the basic necessities of man. It's a tangible asset and can be directly controlled by the owner. It can be used in financing. It's generally acceptable as collateral in obtaining loans. It can provide periodic income when leased out. Disadvantages of investing in real estate. It requires a number of years to realize profit on the investment. It's immovable so that it's not easily transferred from one party to another. Mortgaging real property requires certain procedures adopted by lending institutions, such as credit investigation, property appraisal, and maintenance of required deposits. Upon death of the investor, real property automatically forms part of his estate, which is subject to inheritance tax. It involves a big amount, making it impractical to dispose of in case the investor is in need of a small amount for additional capital. Its price is adversely affected in times of crisis. In case of chaos or war, it cannot be easily disposed of. Time for the module quiz. Read the questions carefully. Click on an answer or multiple answers for some items. Click on Submit to continue. Click on the arrow to begin. You have just completed Module 1, The Basics of Investment.